TheoTrade. This is Don Kaufman. January 21st, 2022, a day to remember inside of the marketplace. Here we are doing the weekend update here on a Friday afternoon. Are these markets sending a message to the Fed? Of course, the FOMC meeting is due up this next Wednesday. Let's get to that and much more here on this weekend's update. I want to start with, I think, a phrase that I use all the time here at TheoTrade, and that phrase says, are you feeling the fear? And that is to anybody. It doesn't matter whether you're long, whether you're short, whether you're an option premium seller, option premium buyer, okay? Are we feeling the fear inside of this marketplace? I'm going to tell you right now, many of you would probably point to, oh yeah, I mean, looking at this marketplace, I mean, specifically the last two trading sessions, this is not pleasant by any stretch of the imagination. A lot of people know that I have maintained quite a number of short positions. Listen, that's neither here nor there. I mean, we're getting hundreds of emails every single day in order to try to mitigate exposure of many of our clientele that are, if you will, kind of feeling the fear. So, you know, we take no pleasure in obviously a market that's selling off, but the diabolical nature of some of the moves that we've seen in the last two trading sessions are precisely what we have been cautioning about for such a considerable period of time. The market's not going quietly off into the night and seeing sell side activity. There are absolutely violent attempts at just ripping rallies in here. Today is no exemption to that, with a fairly precipitous sell-off after the cash open, absolutely ripping rally, only to be literally dropped on our head. S&P is closing down 93, but I would have to say that the trading session that probably caught most of us not just off guard, but pretty much took your breath away as a trader was, of course, on Thursday, which staged a substantial rally all the way back up to almost 4,600 before a just wild decline. I mean, this is one trading day where you're trading roughly 4,600 down to the 4,440. But I'm going to tell you right now, and that's when I start to say, like, are you feeling the fear? Listen, I sold premium into yesterday's close. It's Friday, and I sold some premium here into Thursday's close, and just, you know, watch that thing get absolutely unequivocally smoked. You know, when we're trading, you know, at 44.40, and of course you end up, you know, 43.80 and change. That is again not a pleasant experience by any stretch of the imagination. What I'm going to try to do over this weekend's update is kind of break down some of the sectors, the volatility inversion, all right, and we're going to read into a little bit of obviously what the marketplace is anticipating risk to be, you know, obviously forward risk is going to be huge. You know that volatility exploded. I know volatility exploded, but there is going to be some positive aspects of this and some very dire aspects of this. But a lot of what we're going to discuss here, it does hinge in very large part on the FOMC meeting, which I'm going to cut to the chase in here and tell you right now, unequivocally, I believe that this is a message to the Fed. You do this, you pull away my punch bowl, the market is hooked on the juice, people. They're hooked, okay? Period. Low interest rates, forget about all that, okay? It's the balance sheet that this marketplace is hooked on right now. Let's get down to business here before we go too far into the FOMC. Talk a little bit about, are we feeling the fear? In terms of sectors, it's one thing, of course, to say, behold, look at the S&Ps. You know, one of the first things I like to do when markets get downright wild, and I will constitute this as downright wild, and I'll show you exactly why when it comes to some of the statistics. Of course, I'm a much more quantitative trader. I don't sit here and examine the chart and try to figure out, you know, particular levels. I do have some levels in mind that we're highly likely to go to. But there's one aspect I learned very early on about looking, you know, at charts and so forth, and that simply comes down to something like the spiders here. Go ahead, open up a 15-year weekly. And the reason that I'm doing this is not to explain anything other than the fact that when you can see, okay, the volatility, picking up specifically on like a 15-year weekly, you got yourself some problems. And right now, we got ourselves some problems. This is a very significant beginning to a move. There is no question about it. You can talk about breaking trend, and I'll zoom in over here for a second. Clearly, that is done. But when you start to open up an even broader chart, you can actually see this is now max spiders. I'm not comparing this to the decline, okay, of the internet stocks. I'm not comparing this to the financial crisis. I'm simply showing you, okay, in the largest context possible, even on a monthly chart, you can now see how substantial this move has actually been in such a short period of time. You can't even believe that we just came off of, this is only a 4-day trading week. All right, Monday, we were closed for MLK. It's a 4-day trading week. It is that significant, right? And you should read the risk, okay, in that significant of a manner. Bottom line, and again, I show you this predominantly because the last move in this marketplace coming out of the COVID crash is of a parabolic nature that I have never seen before in a major index product. All right, that move is almost vertical, and unfortunately, the move down now is starting to grip with a little bit of teeth. All right, from a sector point of view, I have a little bit of concern right now regarding when you start looking at like year-to-date percentages. So the spiders right now are down about 8%. Then we actually jump over to the QQQ. The Qs are off about 12%. Cause for concern. I'll tell you exactly cause for concern. You start looking at the financials, they're only off by 3%. Now, granted, the financials, maybe they underperformed a little bit last year, yada, yada, yada. Give you every excuse in the book, okay? These are still dramatically outperforming. In fact, when you look at the financials in comparison to a lot of other products on the screen right now, the financials, they're almost, unencumbered at this. This is not even scraping the surface. Even worse than that is when you start to actually look at a sector like energy. Energy came down hard and fast. I would expect this to come down much more considerably along with the financials in there. We can actually dig apart individual stocks. We knew that if the marketplace is going to come apart, the marketplace is going to come apart on the back of the monsters of tech. And the monsters of tech, which are very, very specifically the monsters of tech are Microsoft, Apple, okay, Amazon, Facebook, Google. But okay, to stand on their own, you got to look at Tesla. You got to look at NVIDIA. There's no question NVIDIA is taking a fairly substantial hit. Actually, on a year-to-date basis, things down 22%. That's more than a hit. Okay, that's big boy bear market territory. Tesla is down about 21%. I do have cause for concern specifically to Tesla. It still looks rather unscathed overall. With its earnings coming up next week, we are on the dance floor for another considerable move. This is going to be an impact to the overall Nasdaq. There's no question about it. It is forthcoming, okay? The other major concern over here is Google actually broke 2,700. This thing is off to the races a little bit. Again, major earnings forthcoming. Everybody's talking, of course, about none other than what occurred inside of Netflix. Listen, neither here nor there. Its market cap was not enough to drag down the overall market. Now, that's not to kind of, gloss over the fact that this was serious damage incurred. What I found really interesting, though, about the decimation inside of Netflix, it actually took Amazon with it. Amazon, this is full-blown hideous territory. And right there, okay, right there is where actually the Nasdaq started to fail today. I mean, specifically Amazon with a 6% down move. In fact, on a year-to-date basis, down over 16%. People, these are not small numbers. This is not, this is not anything that's going away anytime soon. Listen, you're in it right now. You're in volatility. And, the question is, are you feeling the fear? Well, you weren't until you started listening to this, right? So from a sector point of view, you got to expect more sell side coming energy, got to expect more sell side coming specifically into the financials. The financials, maybe they're holding back right now, waiting for the FOMC. But when it comes to tech, you may hear some okay earnings coming out of the likes of Microsoft. Listen, everybody's up to bat this next week, okay? This is not, though, going to be center stage. What's going to be center stage is not going to be Microsoft, okay? It's not going to be Apple's earnings, okay? Everybody's, this is Amazon. Amazon's actually the following week. It's not going to be Facebook. It's going to take center stage right now, of course, is the FOMC. But more importantly, okay, the overall marketplace is gripping hold at this point. Now, before I go any further on that particular front, got to talk about a volatility inversion. Everybody's looking at the VIX. The VIX spiked, okay? The interesting thing to me, though, is the VIX didn't even get It didn't even get into the 30 handle. It came just shy of it, didn't even get into the 30 handle. Now, this actually leaves, if you will, room for improvement to the upside in volatility. Like, I don't look at this as a positive. I actually look at it as a negative. Volatility has spiked, but we're not exactly rocking. Why do I have cause for concern? Because the last time that we were down at these levels, the vol did get up to the 35 handle. When I say these levels, specifically, this is actually December 3rd. So on December 3rd, there was some rock and sell side activity. But in comparison, we only got to 4,500. Well, we smashed through 4,500. The VIX is not rocketing, okay? But at the exact same time, the volatility, okay, and the volatility futures, we are inverted, and we're actually inverted in a fairly substantial way. This actually changes how, okay, market-making firms are going to mitigate risk, how volatility arbitrage traders are going to mitigate risk. When I start talking about a volatility inversion, I don't mean to geek out on you. Here's the bottom line. See these 26-day, which is a February volatility future, okay? They're trading for roughly 27.40. Then the back month, okay? Back month, what's back month? 53 days out is trading for what? Okay, 26, roughly 99. So almost 27. And then even beyond that, 89 days out, what are we trading for? Okay, 26, for instance, 77. This is, it's so strange to explain because what you're saying is that 26 days from now, literally holds more risk than 89 days from now. And that doesn't even make logical sense. Like, how could you have more risk with 26 days than 89 days? And the answer is because we're in the throes of serious volatility. That's when, when volatility gets inverted like this, you got to throw caution to the wind. If there's one key in here that say, the market's sending the message to the Fed, let's actually push that aside for just a second and just say, doesn't matter what you think, doesn't matter what you know, doesn't matter about levels in the S&Ps. I'm sure everybody's talking about, this level and that level. You got to push all that aside. When volatility futures are inverted, no one cares, okay? This is sell, okay, and ask questions later. They are going to fire into this marketplace. These volatility inversions are few and far between, but when the volatility inversion hits, it is on, okay? What actually occurs in here is once the February exceeds, for instance, March or April, it actually causes firms that are caught inside of this trade. And when I say they're caught inside of this trade, it's, this eludes a lot of people. A lot of firms like to go out. They like to sell short-term volatility, and they like to buy back month volatility. But the moment that they're selling, the product that they're selling over here explodes higher, okay, what do they have to do? They have to hedge. They just can't, you can't just go out there and start, I'm going to buy this back. I'm going to get out of the trade. They're going to get killed. So what do? To mitigate the exposure, as this volatility starts to climb in the short duration, they sell S&P futures. They sell S&P futures to actually mitigate the risk, and they're going to do it in a dynamic fashion. That's when things can get downright vicious in the marketplace. The other aspect that really kind of resonated with me, I was rather surprised by this, is skew. It jumped. That is a big, big move. Okay, big boy move in skew. So skew started to jump back. Now, when I say that skew started to jump back, and in this case, I'll actually use a line chart. Okay, it's a pretty significant jump back in skew, which means that towards the trading session, traders were actually reaching and buying, okay, out of the money puts. And ultimately, it started to pick skew back up. This is not that considerable, however. Again, I have a lot of cause for concern. It's still back to 136, but skew definitely jumped a little bit. So there's a huge negative with the volatility inversion. But then we look at skew. All right, people are finally starting to go out there and try to mitigate some of the risk, okay? And with that, and this is also kind of disconcerting, the bonds went bid. Okay, bonds now are actually rallying. And you're like, wait, that doesn't make sense. Isn't this whole thing about interest rates going higher? When interest rates are going higher, shouldn't bonds be selling off? Yeah, unless, of course, okay, the proverbial risk hits the fan. And once the risk hits the fan inside of the S&Ps, traders, there's nowhere to run to, nowhere to hide. Where you gonna go? Look at the tape. Close this up for a second. Look at the tape. There's a whole lot of red on the screen. Where are you going to go to? Where are you going to run? Where are you going to hide? People go, I'm going to go to cash. Yeah, well, if you have $5 billion under management, most people probably don't know this, but when you have substantial capital under management, there is no cash. You can't go to cash. European traders can't go to cash. What are they going to do? I'm going to park my money over the weekend at the bank where there's negative interest rates, and I will pay them to take my money. Okay? Doesn't work that way. They're going to come in here and they're actually going to buy U.S. bonds. They're going to buy those bonds because you know what? Even if the bonds pay you nothing, it's better than putting your capital into cash because they're going to charge you for it. So ultimately, the bond's gone bid. I don't look at that as a positive. I actually think it's a negative because, in light of everything that's going on, all of a sudden you're like, yeah, and then I had to go out and buy bonds, man. Oh, that was wonderful to have to do that. You're buying bonds. Why? Okay, because it's duck and cover. That's what it is. It's just simply duck and cover. To a little bit of a kicker in there as well, like the VVIX. The VVIX has gone absolutely parabolic, like the 150, when that's the volatility index. All right, moving along over here. So in terms of sectors, the sectors that kind of watch, right? The Nasdaq is like probably an oversold territory. Everybody's going to say that. But when it comes to like financials and energy, it's not. The volatility inversion is going to change the nature of the trade entirely. I mean, the bottom line is when volatility inverts, it just makes trade outright sketchy. And you can feel it, you can taste it, you can touch it. And if you're new to this business, this is what it looks like. And listen, I don't want to hear about levels. And I really I'm not being sarcastic in any way, shape, or form. You start yapping to me about levels, I'm going to shut people down in an instant, because when you're pumping through 7,000, 8,000 contracts in a minute in the S&Ps, that's what we were doing this morning. This morning's trade, okay, was an absolute hallmark, if you will. It's exemplary of extreme volatility. When you're pumping through 7, 8, 10,000 contracts in a minute, it is a fire hose turned fully on. The spigot is all the way open. No one is holding onto the hose, and the S&Ps are just going to go wild all over the place. This is basically the way I put it. The fire hose is a great analogy, but it's every man, woman, and child for themselves at that point. And one of the craziest things, though, of this, okay, is as we were selling off, significant sell-off, the contract size actually dropped. That is very, very disconcerting, which brings me actually to my next point. My next point is volume in the S&Ps. The volume really shot up. This happens to be kind of a positive a little bit. What I didn't like, though, is when I started examining the volume a little deeper on an intraday basis. Now, imagine this, and again, you had some huge trade towards the end of the day, but imagine this. You're looking at the volume. It was huge in the midst of the rally. And as we started to sell off, the volume actually faded a little bit. I don't look at that as necessarily a positive. The only positive in here is that the overall volume was of a very significant magnitude. It was almost 3 million contracts. And again, if you take a look at the S&P futures, into the close here, we did, again, just shy of 3 million contracts. Why does it matter? You have to start opening up like a 3-year chart. Open up a 3-year chart, and you're only going to see a handful of times that the volume was that significant. The point that I am making with this, there was real hedging activity. Okay, the proverbial crap kind of hit the fan. There was real hedging activity. It's the most significant volume that we've seen, again, okay, in a significant period of time. The last time that we saw volume like this, you got to start to go back of, March of 21, but it was a brief and fleeting moment. Okay, we're going to be watching volume very, very carefully in the days to come, simply because even if we have an up day, you should see staggeringly large volume inside of the S&Ps. All right, last point I want to make on this particular front has to do with advanced decline line. The advanced decline line, this is also cause for concern. We're not in a fully correlated state. 86 products ended the day down. Okay, when I say we're not in a correlated state, there are still some degrees and some pockets of strength in here. As I was saying, there were aspects like, all right, Colgate, Palmolive, like these are not that exciting, but it's energy. Okay, some of the a handful of financials even finished higher, I saw. But again, it is cause for concern because when you see a marketplace flushing, all right, I mean just getting smoked, you want to see everything down. Listen, this is not an investor talking. This is the trader in me, 100%. You want to see the advanced decline line pegged, people. You want to see 100 products down. There's nowhere to run to, nowhere to hide. You got to feel outright fear. I don't believe that we've actually seen that. And that's exactly what I wanted. That's the point that I just wanted to elaborate upon in going into all of these detailed points, is that people, we just started, if you will, stepping towards bonds. Okay. I mean, this just started. The bonds haven't broken up. I mean, these things could be at 160 before you know it when you really start to see some sell side activity with that onward and upward magnitude of the moves. This also, okay, really kind of resonates with me. Again, there's actually some positive story in here. If you look at the S&Ps, here's the bottom line. The S&Ps had a 265-point move on the week. The expected move of the week. The expected move means this $85, okay, and 74 cents. And I actually want to write it up on the screen over here because I think it's absolutely critical. But the $85, okay, and 74 cents is what was expected. Actual move, 265. All right, that's what that highlighted area is. It's the breach of the expected move. That breaks down to just about 3.1 standard deviations. Now, the standard deviation, the only calculation I'm using is that $85 just divided into 265. Net, you're looking for an $85 move. You got that? Yeah, you got a 265-point move. I mean, today was an 85-point move. Okay, Tuesday was an 85-point move. That's how significant it is. On the Qs, in terms of the QQQ also saw precisely a 3 deviation move. You look at auto expected moves, the QQQ had a 28-point move. Its expected move is around $9 and change. Net comes out to a 3 deviation move. I also think it actually begs to be discussed over here, the crypto market. And the reason I'm bringing up the crypto market is not to do anything other than to explain, okay, this is a full-blown crash inside of the crypto market. This is actually Bitcoin. Specifically, these are Bitcoin futures, but on a year-to-date basis, they're down 20%. Again, a full-blown crash inside of crypto, specifically today, down almost 14%. If you take a look at BITO, which is the ETF, the reason I'm looking at BITO is to give you a little bit of a feel for how significant the move was. You realize that BITO was almost unchanged as of yesterday. The break lower today, substantial, but this product expects huge moves. Here's the most interesting thing about it and why I actually put this in here. The breach of expected move wasn't even really like 2 deviations. So I figured I'd throw that one in there because when you're looking at crypto, you're like, that thing got smoked. But it was expecting heavy volatility. It's always expecting heavy volatility. And net, with that expectation of heavy volatility, it only really had like a 2 deviation move, just under a 2 deviation move, whereas the other major indices had a 3 deviation move, and all of a sudden you look at crypto, you're like, it got smoked, it's down 14%, and you realize, oh, wait a second, it's actually not as bad. All right, let's get down to business here. FOMC meeting. It's coming up. If you haven't looked at a calendar, which we will look at here momentarily, this Wednesday is going to be an FOMC announcement. Of course, every FOMC announcement also brings a press conference from none other than Jerome Powell. I'm going to give you a quick, dirty feel for exactly what you should expect out of this FOMC announcement. Number one, are you willing? Is the Fed willing at this point in time to crush the markets, okay, to fight inflation? That's something that each and every one of you has to ask themselves, okay? One of the things, though, that I have to stress over here, before going into too much about this is, there's been some declining economic indicators. And with those declining economic indicators, when I talk about declining economic indicators, everything from like retail sales to like empire, manufacturing, there's not too much. And then like the jobless claims came out and those are rising. There's not too much to go off of. But I'm going to tell you right now, there is enough declining economic data right now, coupled with the fact that the S&Ps just got smoked, that the FOMC could absolutely soften the hawkish stance. Everybody's like, they're gonna have it's gonna be 4 interest rate increases, and then Goldman Sachs goes, no, five interest. No one cares what you think at this point. It's going to be the statement from the FOMC. Okay, I don't think they're coming out with a 50 point hike in March. Forget all of that. All right, listen, I think they're going to soften the hawkish stance using a lot of verbiage just to talk the marketplace off the ledge. Listen, you don't want to crush markets to fight inflation. All right, the markets are clearly hooked on the juice being the balance sheet. I don't care about, oh no, we're going to move the rates from 0% to 1%. Who cares if it's 4 or 5 rate increases? It's still 0 to 1.25. That's 5 it's ridiculous. All right. Again, it only takes just a few trading sessions to change the Fed's, feel completely for this. And no one, okay, is going to feel more pressure than Powell politically, economically. I mean, this is something that is going to pressure. And you remember, Powell, his experience is not as an academic. His experience is as a trader. Look for the Fed to soften some of the hawkish stance. Last but definitely not least, probably one of my favorite things to discuss over here happens to be none other than the expected move. We just came off a 4-day trading week. $85 expected move. We're actually coming into a 5-day trading week. It's going to be a $150 expected move. Put on the big boy pants because we are going to be rocking. Behold, $150 expected move. Now, you can look back for a fairly considerable period of time and you will see some substantial expected moves. People, this one is right up there. And by the way, I've been tracking expected move now for, well, you can see this is a 3-year chart. Even during the COVID crash, the magnitude of some of the moves were just hideously wild in here. By the way, this is over a 200-point expected move in there. I looked back a little bit, but we have the largest expected move since the onset of the COVID crash, and you should actually kind of heed the warning over here. There's no question. Okay, the markets are sending a message to the Fed. There's just absolutely no question. The only problem with that is, yeah, that Fed meeting doesn't happen until Wednesday. We're going to left to our own devices, obviously, on Monday and Tuesday to throw a little bit of a kicker in there. We'll see actually if there's any progress, obviously, on the Russian front, which could only throw risk into the markets a little bit further there. I'm actually referencing Russia, Ukraine. That is, again, all to generate much more fear to this marketplace. Again, be aware when we do open up on Sunday evening, those futures are going to be a rockin'. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.